This is a continuation of educational form of these markets. We have talked about candlesticks in the previous video, and now we're going to talk about the three conditions that the market can be in. So, as you can see here, there is an actual candle forming, and anyone who had understood the previous video that I've shared, you will understand uh, what is the wick and what is the body, and the open and the close, and you will understand why this movement is giving us a black color instead of green. Uh, that this place, which is the upper body, not the wick, the body, the upper body, is the open. And since price was playing under that, that's why we had a black color. If price was playing above that, we will be having green color. Like in this case, price opened here and the candle came up here and it was at some point green, and when it came back down, we had we are seeing black color, and this week is telling us that this point is the maximum level price is being in. This point is the maximum level price had hit, never went above this. If price now goes up, we will see wick. If price now goes up, we will see wick, which in which case that wick tell us that this was the max level price had been in this exact minute, because we are in the 1 minute chart. If you are ever confused which time frame we are in, you can see here. If I change it to the 1 hour, we'll see another candle that is moving slowly, well, much slower than the previous one, because this is a 1 hour candle. Of course, 1 hour takes time than the 1 minute to pass. That's why this candle is slow. The 1 day candle is even slower than this. And for example, if we go to the 15-second candle, price is faster. Well, at this time, price doesn't move much. At some other time, price can go up so fast, like this. So let's talk about, let's go back to the 1 minute. And I zoom back, and I want you to look at this closely, all of it, and try to understand what is it doing here. If you can see this movement and this movement, this movement, and you keep doing the same thing, you will see that the market either, let me grab some tool here, let me remove that middle line, you don't need it here. Okay, so price either consolidates, which means it goes up and down in the same range, the highs and the lows are nearly the same, or the price goes down aggressively, like in this case, or it goes up, another small consolidation here, you can see it, and then price drops, in which case we call it bearish momentum. This is a bearish candle and this is a bearish momentum, and price goes up, which we call it a bullish momentum, because this is bullish candle, bullish candle, bullish. This, all of this is bullish momentum. It's called bull because the bull, when it attacks, it lifts things up. Bear, when it attacks, puts things down. That is why this is called bearish, and that is why this is called bullish. We have another consolidation here. Maybe some of you have already seen it, and it doesn't need to be perfect, as you can see here. The bodies are nearly perfectly in the same place. These little imperfections doesn't matter. This is a consolidation. This is a bullish momentum. This is a bearish momentum. That's all the market can do. It can't do nothing else more than these. Nothing. Only consolidation or there is a some well, there is a context why price does this kind of things. Well, there is a squeezy, another squeezy consolidation here. You can see it's squeezing so much. And then bullish momentum, bearish momentum. And this phenomenon tends to happen in all time frames, no exception. All right. So I will not use boxes as I want you to notice these things by yourself. I will go to the 5-minute time frame. Let's go and read it from here to here. Okay. So this is bearish, bullish, consolidation. Bearish, bullish. Well, it's not by much. There is no much volatility. By the way, volatility means how market speeds. For example, this is a very aggressive volatile market because it drops sharply from this level to this level. That's a huge drop. Okay, and then let's continue here. We have some little bearish momentum, then bullish, bearish, bullish, some consolidation here. Well, anyways, for example, let's highlight this area. Some consider all of this consolidation. It depends on their style. Some see movement here. For example, in high frequency trading, some people trade from here to here and from here to here and they're done. Some people wait for these kinds to form, these kinds of movements to form. They're intraday traders or like swing traders. It depends on the time frame. And I know this is a little bit confusing, but you will understand this but you will understand this more. So I highlighted this. So when we go to the 1 hour time frame, we don't see much candles here because inside each 1 hour candle there is 61 minute candle and 4 of the 15 minutes candle, and that's why price is fractal. In this case, for example, if we go to the 4 hour, in the 4 hour this is consolidation, but when you go to the 1 minute, that's not consolidation, that's significant movement. Though I know price stays inside the range, which means it doesn't go outside or up aggressively. It's trading inside the range, which means it goes up aggressively, down aggressively, up aggressively, down aggressively. But it's inside the range. But it still can't call it consolidation. This is a consolidation. This is bearish. This is bullish. This is consolidation. But all of this is a consolidation in the 4 hour, as you can see it here. That's why I like using boxes, so you can understand some things. Um, let's go to the 1 day chart. 1 day I want one chart. For example, this is one daily consolidation. Price consolidates for 1, 2, 3, 4, 5 days or more. Like if you include this candle for 6 days, this is a consolidation. Before we had this movement up, this is a consolidation. Let me mark that. So, and if we go to the 1 hour chart, daily consolidation, not that one, this one. This yellow box, don't look at those areas I marked. Inside this yellow box, this was a daily consolidation. But does these things looks like consolidation to you in the 1 hour chart? Of course not. These are significant movements. For example, this is 1 hour consolidation. Inside 1 hour, you will find many 5 and 1 minute candles, but are not consolidating. They're going up and down aggressively. Okay, understanding this is understanding trading all of it. The other things are just concepts. This may be the most confusing thing in trading, understanding the connection between the time frames and the candles and the formation and the three conditions that the markets can be in. No more. It either goes up or down or consolidates like this. Um, so this when you understand the fractal, and by fractal, which means everything is connected inside this. Understanding this makes you understand so much in trading. And when you look at the bigger image, let's go to the 4 hour, for example. Price tends to, for example, it has a trend. It starts, for example, trending from here. Let's start from this point. You can trade all the charts from like from 2020, for example. Just take this part, for example. Price is going up to this point. I don't care when price goes down, because price can't go up in a single move. It's always going up and down, but trending upside. This this is the price trending upside. This is called uptrend or bullish trend, and then starts to fail, starts to be exhausted, consolidates a little bit here and drops, and then goes up again. Okay, and then drops, and then goes up again, and then drops, goes up again, and then drops. Before price drops, it will give us some, how do we say? It will give us some indications that it is failing. For example, price was going up here, and then this candle drops sharply. It indicates that price is failing. It's exhausted. It can't go up anymore. That's why we predict, for example, we can't see the other candles because we are in the meantime here. When we see something like this, we expect that price is being exhausted, and we expect this bullish momentum to end and it becomes bearish. That's why this happened. For example, price is dropping, and when we see something like this, price going up, which means it's gaining some momentum, gaining some power to go up, then you can wait for more confirmations. It went up again, and then boom, it pulls in the upside like it did here, and then price drops, failed. Here where you expect to be a seller because it's going down. When it goes up, when you expect price going up, you'll be a buyer. When you expect price to goes down, you'll be a seller. That's it. Okay, let's talk about the market structure shift. The market structure shift is a shift in trend, which means the market is shifting the structure. This is downtrend, which is the structure of the markets going in the downside. Then when the structure wants to go in the upside, it gives us the market structure shift. How we can spot a market structure shift, which means the market is trying to go up before it goes up. So at this point, we know that the market it wants to go up. The first thing we look for is a market structure shift. Okay. When we see in this downtrend market, we have many lows and highs. Let's mark the lows and highs. This is a high. We mark only the significant highs, okay? This is another high. This is another high. This is another high, maybe this one. This is another high. And of course, we have some lows. One here. Let's look only for the significant ones. Another one here. Another one here. And the last one is here. Not the last one, this is the last one. Okay, so the market is going down. It broke this low sharply, then broke this low sharply, then broke this low sharply, then broke this low not very sharp in the sharp way. Then what happened after that? The next low could not break uh, below this. We can't know for sure that the market is going up when we see this, but we can have some estimations. Okay, all right. So we keep seeing the price. We have some momentum here in this exact candle, and we don't predict anything until this high is broken sharply. Not with a wick, with full candles bodies, just like in this case. Okay, we mark a line here so we make it easier to see. The market breaks above this high sharply. Now we have a market structure shift in which called MSS. For this means a market structure shift. So when the market structure shift happens, we wait for the price to come back to the discount. The discount is the mid-range. Okay, let me draw something here. We mark the range that happened, the range that made the market structure shift. Starts from here to here. And we have the middle line of the range that's made the market structure shift. This is the middle line. We wait for price to drop below the mid-range, and we be a buyer then. How? Enter at this place. This is our protection, and this is our take profit. This box is just a visual box for an actual trade that can happen. You see a box like this. The red area is your risk area, and the green area is your reward area. In this case, we have 3.16, in which means if you risk $1 and you buy here, you risk $1. If the market comes here and touch your stop loss, you lose $1. If the market goes up and touch this level, you win $3.16 exactly. $3, okay? You have to always put your risk limit. You don't do something like this, enter and you wait for profit, and if price goes down, you keep losing more. No, of course. You have to always minimize your risk, like this. The concept of the box is easy. The separation between red and green is the place where you entered. You will be losing some it's not that you're losing, but when price was when price drops here, you will see like minus 0.5, for example, here minus 0.1 or 0.2, and until it spikes above your original entry, so you start seeing profit. If you close your position here, you will be taking just $1 because it says 1-to-1 risk reward ratio, in which means for each dollar risk you will be earning one. But of course you will not be risking $1 in your positions. You will be risking, for example, 5 or 10. I don't like that. I prefer to be having funded platforms. So let's say, for example, you risk $5 here. In your take profit, you will be having 15 because for each dollar risk, you have 3. That's it for now. We have talked about the candles and the conditions that the market can be in, and we have talked about trends, downtrends and uptrends. Of course, in the uptrend, there is highs and lows. Price dropped again here, so you'd normally expect price to come back up to the premium of the market and you be a seller. So we mark our area like this. Because this candle took this low, which gives us a market structure shift. you'll be a seller above the mid range, so your position would be like this. Your stop above the high, and you're targeting the last range that formed, and you'll be rewarded with almost 3 risk reward ratio. Anyways, I think that's it for now. I will be sharing more technical things on Discord on the T2H channel. So when you watch educational form of on how to learn the concepts and the logic of the market in depth, this is just the basics. And of course, from Michael ICT. But anything you don't understand about basics, you just we'll be making maybe another video about them. Thank you for watching. That's it for now. Good trading.